Most entrepreneurs will run their business based on a gut feeling. But the way I describe it is the numbers should tell the same story that your gut feeling is telling you about running your business.
Ever tried to run your business by checking your bank balance every morning? You log in, see a number, breathe a sigh of relief or panic, and make decisions from there. Sound familiar? Yeah, me too. So many of us started that way, sifting through spreadsheets at midnight, trying to guess whether we can afford to hire, invest, or even pay ourselves. But what if the numbers in your business could actually become your superpower instead of your stressor? That's exactly the transformation we're diving into today because it's time to move from guessing to growing. Hey there, I'm Deirdre Martin, your host for the Master Your Business podcast. I'm a triple certified, award winning, international best selling author obsessed with helping brilliant entrepreneurs like you make your first 100K or hit that juicy million. And today I'm beyond excited to introduce someone who has been a total game changer in my own business. Our guest today is Edel Hayes, the founder of Accelerate Accounting. She's a chartered accountant with over 15 years of experience, and let me tell you, she is not your typical accountant. She doesn't just crunch numbers, she empowers online business owners, especially women in service-based businesses, to understand their finances, use them strategically, and grow like never before. Edel turned my business around, not just with systems and compliance, but by helping me shift from reactive to proactive clarity around my numbers. In this episode, you're going to discover the 5 essential numbers every business owner must know without the overwhelm, how tools like Xero can give you crystal clear insight into where your money's really going, why debt collection isn't dirty, and how to finally get paid on time. The surprising truth about credit cards, profit extraction, and pensions. Yes, we're going there. And how to use your financial data to make decisions, not just do damage control. So if you've ever felt like the number side of your business is a confusing mystery or something to be avoided, where you bury your head in your sand, this episode will flip the script. Right, let's go. Edel, thank you so much for joining me today. Welcome to the Master Your Business podcast.
Thanks for having me.
Edel, you have been my accountant for the last year or thereabouts, and you've totally turned around my business. And I know that you mostly work with online business owners, as I've already mentioned. But what I think is really important is that you have been more than just an accountant to me. You've been like a strategic advisor as well. So I wonder, would you just talk about that for a second? Because I think a lot of people think of their accountants as just sending in their tax return. So talk to me about how you got into that kind of stuff that you're doing as well, and how you got me on the right track.
Good stuff, good stuff. Yeah, like so there's many different types of accountants, and it's very much, I do tell people if they're coming to look to work with us to shop around, because there's different personalities and you need to find someone that's a good fit for you personally and then for your business too. So that's the first thing I'd always tell people, like, it is important to have a good relationship because you're more likely to ask questions that, you might shy away from otherwise. I got involved in working the way I work now. I had worked in a very traditional practice beforehand. And then I moved into the corporate space and I was working very much with larger businesses, but like working with them operationally. So in the detail, in like making decisions on a day-to-day basis that were affecting the business in a rapid way. And that gave me a different spin on how to actually support business owners. So, and that's kind of where I come from. It's, you can have your accountant, that's your tax accountant or your end of year accountant, and they will do everything that you have to do. CRO accounts, tax returns, all those things that you're an absolute must. But I look at them as like, that's the foundation. That's what you have to do. None of that is going to move your business forward. It's too reactive. The information is old. It's not going to provide a whole lot of value if you're looking to grow your business or change your business or just mold your business to suit you personally. Okay. It's very much, it's done in a certain way for the authorities. And yes, you're fully compliant, but there's not much value elsewhere than from that. So that's the way I look at it. That's the foundation. And then you want to think about, right, now how do I want to run my business for myself? And that's where I think we add value by providing information that's sits on top of that basically. So using your financial information and having more timely information to impact your decisions basically.
Yes, you definitely do add value to that. So amazing. Thank you. And Edel, one of the things, like I was recently at a networking event, and in the networking event, I was facilitating it actually, and we were doing a rapid fire mastermind. And one of the things that came up, a fantastic lady in the network, and she has worked as an accountant, just like you, in a company, and she's doing her own accountancy thing now as well. But one of the things that she'd said, and this was her sort of question in the group, was that, how do I help people understand that there's numbers that they absolutely need to know? And I know for me, like I come from a banking background, I used to have to analyze sets of accounts to say, is the repayment capacity there for somebody? Is it proven over the last few years for me to be able to lend them €1 million, whatever it is, and decide whether that was something to do or not. But running your own business, it's so different. And I think like where she was coming from, and I know I probably was like this when I was in my solopreneur capacity before I switched to limited company or LLC, for those of you listening in the US, where I was at was I was probably just looking literally at the bank balance all of the time instead of the other important numbers. So would you just explain, please, in layman's terms, what the important numbers are that we should be looking at as business owners? Because again, like, even though I understand what they are, it's so very different when you're in the driving seat of the business. So I'm not going to claim that I'm going to sit here and I know and understand all of them from my own business perspective. It's so different when you're in the driving seat.
Yeah, that 100% is. But there is that mindset piece with entrepreneurs that, and it's not even an entrepreneur thing, it's a human thing where we understand the bank balance so easy. It's just a natural thing. You can log in, you can see the bank balance. That tells us a certain amount of information, but that's an easy concept for us to do on a daily or weekly basis. But most entrepreneurs will run their business based on a gut feeling. And it's usually like, I have an idea of how the business is doing, and they have this almost fear. A lot of people have a fear around the numbers in their business, even if they're really successful. A lot of people will have a fear around looking at the numbers for everyone has their own reasons. But the way I describe it is the numbers should tell the same story that your gut feeling is telling you about running your business. So there shouldn't be a fear there. You should know how your business is doing. And if you have that feeling to pit your stomach, something's off, your numbers are going to tell you that same thing. But it's just facing the reality and dealing with it and knowing exactly what's happening. And the numbers should tell you what to do more of and what to do less of. So it allows you to drill into like, okay, that ring fence that one thing and focus on that one thing to make a change. And again, it's about doing that in a timely manner. So doing that as quickly as possible will change your business. If it's a good thing, do more of what's good. You'll bring in more sales, more profit. If it's something happening that's off, that's not quite right, that's leaking profit, solve that problem quickly and then move on to the next thing. So that's kind of where I would come from, the perspective of, as an entrepreneur, you cannot ignore the numbers. You just can't. There's no one else responsible for them, only you. That's a hard fact to just really to let settle, but it's true. Like you have the ultimate responsibility, but your numbers just reflect what you're probably doing on a day-to-day basis. Anyway, you just have concrete fact of what's happening. In terms of then of like what to look at, so the cash in the bank, that's a good place to start. But again, it's like you said earlier, it's the foundation level of where to start. Okay, so a lot of people will think about, if you're not used to looking at numbers, think about break even. Okay, so how much do I need every week, every month to break even? So just costs are equal my sales, I've no profit. Okay, that figure should be our absolute base point. And then from there, everything after this, I'm making a profit. Okay, and that means you don't have to literally get into the details of financial reports if you're starting out and you're dipping your toe into using your financial information. Okay, look at what costs you've got every week, every month, and then that's your break even, and use that as your like, right, I need to hit that target and move on from there, and everything else is profit after that point this week. Okay, it focuses you on like generating income basically, rather than just being reactive. So that's the first thing everyone should look at. Profit margin. So everyone talks about profit margin, and there's quite a lot of people that still don't understand it. But it's basically your sales less your costs are equal to your profit, okay? And then that figure as a percentage of your sales is your actual margin. Everyone should know what their profit margin is in their business, okay? If you're using a system, your system should be able to tell you that quite easily. But your profit margin of your business overall, so that each month you can look at, okay, what was the profit margin this month compared to previous months? And then factoring in if your business is cyclical in any way, if you're launching at particular times, that would show out your figures. But also in terms of the offers you have. So if you have multiple streams of income, is it possible to get to the point where you know the profit on each stream of income you've got? Easier said than done, okay? And that's why these are all building blocks, build a house one brick at a time. Pick where you're going to start, okay? So overall profit of the business, if you're tracking your income, tracking your expenses, you have that number already, you're probably just not looking at it. And then eventually you want to get to the point where you can do that same thing for each income stream in your business, okay? So the way to do that is to think of what costs relate to a particular income, okay? So if you have a staff member that only works on a particular program, that's going to impact the margin on that. If you have a group program compared to a one-to-one program, the margins will be very different because of the time input that you have. And all these things are something to consider. Different types of businesses, though, will have different financial measures they want to be looking at each month. So think about your business and the phase your business is in. So if you're launching at the moment, a lot of your KPIs should be around launching and investments, return on investments on what you're doing. If you're not in a launch phase and you're in a phase where you're delivering to your clients, you might want to look at time in your business for you and your team. So total time spent by paid for the team versus total billable time for the team. So again, we're constantly thinking about outputs for everything we're putting into the business. What output are we getting from that staff member or that investment or that piece of technology? So it's just focus on like where you are in your business right now and what's the priority, and build your KPIs around that. Your KPIs can change quarter to quarter or year to year, but I would always have break even point, profit margin. If you're offering credit terms to anyone, I would have debtor days in there. So if you're offering credit terms where people are paying you manually, that's definitely a number you want to be checking for cash flow reasons. And then build out maybe 2 or 3 more based on what's going on in your business right now, so that you're focusing on things that are actually moving the needle forward for your business.
That's such great advice, and it makes so much sense. Like, I love that break even, because everybody can kind of figure that out. If you have X coming in and you have X going out, is one more than the other or whichever, and that's just the simplest way to explain it. And profit margin, one of the things that you encouraged me to do, Edel, and anybody who was like me before, where you were looking at your cash, you're in that, no, I don't want to call it inflow and outflow, but where I was kind of trying to manage my cash flow from this huge Excel sheet. And I had listed all of my incomings and all of my outgoings, and then I had a dashboard in the front of it that could tell me whether I was in profit or not, but it wasn't accurately set up because I wasn't monitoring the tax and all that sort of stuff. So I didn't really know. But one of the things that you encouraged me to do was to move to Xero. And that has been a freaking game changer for me, because I can look at those management reports monthly and see where am I at. And I was able to do my budget at the start of the year. And like, folks, I'm nowhere near achieving what my plan was. I'm not going to pretend I was. It's been a bit of a turbulent year, but all the same, in terms of Xero, it's been a game changer, because just like you mentioned there, I have different programs. I do workshops sometimes in companies. I do one-to-one. I have my business accelerator. I have Millionize, and then I have some little digital offers that I sell as well. So Xero has been able to help me when the money comes in, allocate it to that specific place so I can see which ones are profitable, which is like, again, it's like, why did I not think to look at that before?
Yeah.
I'm like, I felt like an idiot when I'm like, oh my God, that makes so much sense. Focus more time there, Deirdre.
Yeah, but to be honest, most people have information, they have financial information in their business. You just need to pull it into a system that you will use. So if someone tells you like, oh, use like, you know, my preference is Xero, but if someone says QuickBooks, but you absolutely hate QuickBooks or you hate Xero and you will never use it, there's no point. So finding a system that works for you, that you will use it, that's the key thing, like running the monthly management reports and seeing what's going on, because there's so many people out there that are business owners that are basing things off that gut feeling, and that will get you so far for sure. But having concrete facts, particularly as you're building out a team and there's more people involved, being able to see that information on a regular basis, it takes the brain power away from thinking too much about, is the spreadsheet correct? How do I gather all the information? There's so many automations you can build into these systems that you can remove those tasks from you or a team member, and you can get the information so much quicker. And that's the point. It's like, get your information together, because you probably have it somewhere, put it in a format you'll use. And as a business owner, your time should be spent on using the information, not the gathering, collecting, making sure it's accurate. It's using the information. So like you say, listing out like the fact that you can now look at income streams based on the types of services you're offering. And there'll always be questions. These things prompt questions. So why is service Y not as busy as I thought? Let's look at how the launch went. You'll probably be doing that anyway. The digital products, God, they're doing so much better than I thought. Maybe we should throw some ad spend behind those things, you know, so they prompt more questions. But the whole key is building a system that you will actually use effectively.
Yeah, it's great. And I've had clients as well who, since we've been chatting with, and they've told me that, you know, they've switched to Xero as well. I've been raving about it. My husband, even in the company he works for, is looking at my Xero going, gosh, I think I might implement that in our company. It looks great. And like the information that it's able to give me for such a low cost. And I'm not a Xero affiliate or anything here, folks, just so you know. I don't know if you are, Edel, but if you are,
No, not now.
But it's been phenomenal. A couple of questions I have that I'm curious about it, and this is something that comes up with clients as well. And I mean, when I was doing that relationship management stuff in the bank in Edel, one of the roles that I had would have been, and they don't even do this in the bank anymore, but if a client went overdrawn and they didn't usually go beyond their overdraft limit or go beyond Xero if they didn't have an overdraft limit, we'd ring them and ask them, when is the money coming in, and be able to do it. So it's, and you touched on debtor days, right? So debtor days, folks, in plain English is, if you send somebody an invoice that's due to be paid in X time, but they've gone beyond, it's how long that's outstanding, essentially, right? So yeah. What's the etiquette for invoice, or is there one? Because so what I see happening with people who are service providers or coaches who maybe go into a company or organization, they deliver a workshop, is that those debtor days can often creep up. And in terms of invoicing and collection, like I used to have to be ringing these customers going, when is the money coming in for this? Like, it was a horrible job, you know. But as a business owner, we have to do that as well, because we are the debt collectors in our business. So what have you found that works well for this?
I'd be really clear up front on establishing the process, particularly if you're dealing with multinationals, because a lot of multinationals will have their own policy, and you might put a due date on an invoice, and they have a payment run that goes once a month and you've missed the date. So be really, when you're going into any larger organizations, ask them what their process is, so you're aware of it up front. That might mean you invoice a bit earlier, or you change how you invoice, okay? Especially if it's a once-off project. Always ask who's the contact for processing the invoices. You can get payments can be slowed down because your invoice has gone to the wrong person. It might have gone to the person you were contacted by, but there's an accounts team there and they have never seen your invoice. So these are things you can do beforehand. And always ask, do they use purchase order numbers or referencing? So again, that can slow down an invoice being paid if you're issuing invoices. 3 really simple things, but they're the most common reasons why your invoice isn't paid. So once it's got to the right place and it's got the right reference, if a payment isn't made on time, if it's gone over, if it's a one-to-one relationship like that, I would always say just pop a very courteous email and just ask, I noticed the invoice wasn't paid. Is there any issues? If you have any queries, let me know. And when can we expect payment? Something very casual like that. And I would probably do that when it's a couple of days after, unless you've been told there's a payment date that they always implement. But if you were expecting it didn't arrive, I would pop that email out, because most people are very receptive to it and they'll have a reason, and usually you'll get payment then. One thing I would tell people to watch if you're using platforms like GoCardless or Stripe is to check for bounced or failed payments, because a lot of the time you won't get notified. So with GoCardless, they're quite good at notifying if a payment has failed. But with Stripe, you might look at a monthly report and then realize payments have failed, and you might have got a notification. So you could be still delivering a service and you're not getting paid for it. So I would watch on that side where you're using payment platforms to make sure you're getting notifications. And again, if something has failed, clear, open lines of communication are your best bet, basically. Simple, polite emails will usually get you very far. With systems like Xero, you can set auto reminders. I'm not a massive fan of them because, again, you might have had a quick conversation with someone and they let you know and you forgot to update Xero and then they get a reminder. So I'm not a huge fan of them. I'm more, my preference would always be the personal touch, the personalized email, and then a phone call. It depends on the client relationship. A quick phone call usually sorts issues too, but just clear communication right from the start before you've delivered the service, issued the invoice, you know what's happening. And then at the end, like quick follow-up. Statements are another thing actually. So here in Ireland, it's really common practice to send monthly statements, even if there isn't a balance overdue. So first week of a month, if you're receiving statements from your suppliers or your customers, that's common practice where they'll just send out a statement. So again, if you get that and you haven't received an invoice, they can request a copy. Basically, it's not seen as a rude or a pushy thing. It's just standard practice, basically. So again, that's something you can set up to automatically happen within your system, and it's another touch point basically to prompt people to pay quicker, basically.
Oh, I love that tip. And I have a question on the other side then as well, Edel, like in terms of invoice payment and etiquette around that. Like, sometimes I'll get an invoice in and the due date is a month from now. So I'm like, my instinct is I want to pay them as soon as possible. But from a cash flow perspective, I'm like, oh, maybe it'd be better if I waited for 20 days or 25 days. What's your thoughts on that side of things?
Well, if someone's offering credit terms, yeah, absolutely, you can wait. Like, and again, pre-COVID, most people's terms would have been 15 or 30 days. And there was a definite switch with COVID as people were like, no, it's instant payment, particularly for service providers, because you don't really have any comeback if you've delivered service. So there was a shift around that time, but it would have been the norm for 15, 30 days. And no one would have even thought anything of it. So if you're offered terms, you can definitely take them, particularly if you're in a business that's seasonal with cash flow. If you're launching and you're holding cash, or maybe it's your pre-launch and you're light on cash, definitely use them. So one thing a lot of people will talk about in business is that profit is not equal cash. So you can show a profit in your accounts and have no cash in the bank, or vice versa. You can show a loss and have cash in the bank. And the difference between the two is just timing. So cash reserves will obviously build up year on year, but credit terms will throw off that balance between profit and cash. So if you have customers paying you immediately, but you're paying your suppliers in 30 days, you have 30 days of that cash, basically that cash benefit in your business. So that's a nice place to be. It's not a very common place to be these days, but it's a nice place to be for your own cash flow. But the situation can easily be flipped. You could be paying your team members today and your customer is paying you in 30 days, and you have to fund that 30 days in the meantime. So it depends on the agreements you have with your suppliers, but if someone's offering credit terms, I would probably take them.
Yeah, I think, and for me, I was the opposite. And like, somebody'd send me an invoice and I'd be like, I have to pay it straight away. That was my instinct. And then I was like, gosh, I can't spend anything. I can't pay myself, and I've gone through phases like that. I was paying everybody else and paying myself last. But then, some accountant put a bit of manners on me that told me to pay myself first. And my husband agreed. So that kept things. But one thing that I've come across as well, and I'd love to hear your thoughts on this, is I was at one of the Story Brand summits a couple of years ago with Donald Miller, and he brings in guest speakers. He's had like Amy Porterfield there, and a guy called Mike Wicow. I can never pronounce his surname, Wich or something.
Yeah, I'm not going to butcher it either. Yeah.
Yeah, and you might know him. He's written the book called Profit First. And one of the things that I've tried to implement, he recommends having 5 different bank accounts for your business. Now, I've got 3. I've got one for where all my direct debits come in and my payments come in from clients. And then I've got one where I send money off to for tax, and one where I cipher off a bit of profits or retained cash that I can use to reinvest back in the business. And I suppose you could say I have 4 because out of his recommended 5, because one of the ones that I have as well is when I pay myself my wages, it comes across to me. Well, he recommends having a 5th one, which is for operations separately. So it's an account where everything comes in. And then from that one account, you what's the word I'm trying to say? You just pay out to the other 4 different accounts. So I'd love to hear what are your thoughts on managing cash like that. Is that something you recommend, or do you have a different suggestion?
No, I do like Profit First system. I think for Irish businesses, people have a problem with it because of bank fees, and I always come up against this. Yes, there are bank fees, and Irish bank fees apparently are higher than the norm, but for the benefit of what you're getting and the peace of mind and just the structure and organization of it, it's worth the bank fees, especially if you can get a bank where you can get, if you're opening new accounts, you can get reduced fees. I definitely like it because it ties back to what we said at the start, where every entrepreneur can understand cash in the bank. Everybody understands that. And Profit First puts a structure around that way of thinking. So by separating things into their own cash pots nearly, you're following a system that's going to improve your profitability, but it's using the psychology of cash to do that. So I would always recommend, your current account to pay yourself, obviously, your main bank account. For most Irish people will keep income and operating expenses in that particular account, like that's your operating account. A tax account for sure, and then in the book they call it the profit account, or everyone calls it something different, a slush fund account, business savings, whatever it might be. But that other account, that's like your rainy day long-term account, savings, let's call it savings. Okay, absolutely. Like, with tax, ideally you want to be putting away every month whatever you need for VAT, for PAYE, for corporation tax. Everything should go there, and let the payments be taken from that account. So it's not an account with huge volume on it. It's transfers in, payments to the tax office. For the operating expenses, like you mentioned, having 2 accounts, the idea of that is to look at businesses that have high operating expenses. So you should know every month, let's say I need 15,000 in operating expenses in that account, and you're physically transferring the money from your income account to your operating expenses. So again, once you're doing that physical transfer, it prompts the question of, I wish this number was 10 instead of 15. Like, what's in the expenses that I can cut back on and squeeze the expenses to increase profit? It just prompts, it's a psychology thing. It just prompts you to ask those questions. There's not a huge benefit if you're running a business that's quite lean anyway of having a separate operating expenses account, but it very much depends on your own behavior. Some business owners really do need the separation because it's out of sight, out of mind, it's gone. Whereas others are quite happy to keep the income and the operating expenses together. It depends on how disciplined you are. But to be honest, a lot of business owners nowadays that are really tapping into technology run quite lean businesses. And the majority, especially in service businesses, the majority of their costs are team. So whether that's staff, contractors, freelancers, that's where your costs will be. Whereas with Profit First, it applies to all businesses, including production businesses and products-based businesses. So I don't think there's a need for the second operating expenses account, but if you're someone that needs everything in nice, neat boxes, that's probably a good way to go, and worth the fees. Bank fees aren't actually that high.
Yeah, the way I've found around it, so a bit like tax, and not evading it, I'm trying to avoid it. So with the bank fees, it's very much around deposit accounts. So you can have deposit accounts with no fees on them in the bank. So for the like of that profit savings account, that's a deposit account that I have. And for my tax account, I have that set up as a deposit account as well. So what ends up happening then is once I know how much tax is due, I'll move that into the operating account so
Yeah.
the direct debit comes out of there, and it just saves me fees because you can't have direct debits on most banks' deposit accounts. They just don't permit them. So it's a great way to do it. And it's funny, like, I didn't realize, but actually when I was an employee years ago, I used to manage my accounts that way, because one of the things that used to happen at different times in my career, when, let's say, when the last crash hit in 2008, 2009, part of my role as a relationship manager was sitting down with people who were struggling to repay their mortgages and help them find repayment solutions for their mortgages. So we used to have to go through this big long document. It was like a massive budget document. But actually, I started to do that exercise myself in my own household. Once a year is a really great way to manage the money in it. And one of the things that we did was we set up an account where both of our wages were coming in, myself and my husband's wages were coming in, and all the direct debits went out of that account. And we used to have a spending money account, which was another account that we had our cards on. So we couldn't overspend on the, let's call it the direct debit account. We couldn't overspend on that. We could only spend what we'd allocated for the groceries and the fuel for the cars and all that sort of stuff that we needed the cards for. And it just made things so much easier. But speaking of cards, last year, Edel, I was in Miami at a mastermind, and this guy stood up, and it was fascinating to hear him speak, because this guy had been sued by Nike for $32 million, and his business is still going, right? And I'm like, oh my God, how did he do that? But one of his biggest lessons was it was to take as much money out of your business as possible and not actually leave it in the company, right? And I'm like, oh, that's interesting. And the other thing that he had said was to leverage credit cards as much as possible, because then it's always on somebody else's money. So you can declare yourself bankrupt. They can't take the money if you've no money to pay them, kind of thing, you know. They can sue you, but if you can't afford to pay them, your insurance will cover it and that sort of thing, rather than it coming out of your cash flow. And from a credit cards perspective, he was kind of saying, and you know, you can clock up air miles and you can clock up all sorts of things, so you can end up getting extra rewards on it. But again, with my old bank head on, my bank head goes, Deirdre, that's a bad idea, because credit cards the most expensive form of borrowing nearly altogether. But then my other bank head goes, oh, but you can pay it monthly anyway from the business operations. So I'd love to hear your thoughts on those things. Should you take out all the profits out of the business as much as possible in the most tax efficient way? And credit cards, thoughts on those?
Yeah, with the credit cards, yeah, like you say, once you're clearing that balance on a monthly basis, like absolutely, like there are benefits to it once you do shop around on the cards. Again, but after 2008, like you mentioned, the last recession, there was a massive drop in businesses that were using credit cards. So previously, it would have been a case that like almost every business would have had a credit card for their operating expenses, and the balance would have been cleared each month. And then when the crash happened, there was a bit of a switch. I think people just got so risk averse. And I've only noticed in the last 2 years, they're starting to come back in, where people are, and there's different versions of them now. You know, there's like different, you can have like with debit cards as well, obviously, but you can have for staff members where you can like kind of lock them down for certain transaction types and certain limits then as well. So a lot of businesses are starting to use them for staff that do travel quite a lot or will buy stock quite a lot for your products business. So they do have benefits once you're clearing that balance on a month-to-month basis. That's the key thing, you know. In terms of extracting profit from the business, this will absolutely depend on your strategy for the business. So, and I'm going to say your exit strategy, which might be 10 years down the line, 15, 20, it could be less, but your long-term plan for the business. If your long-term plan is to sell, you might not want to strip out all those profits from the business, because you are going to want the business to look as healthy as possible if you're selling or bringing on an investor. Okay. If you don't think your plan will be to sell, maybe your plan will be to step to the side and have someone else run your business. That's what a lot of people will do. And you will still take drawings, will still take salary, pension contributions, those kind of things, but you will step to the side and not actively run it. Then you want to make sure that you have a good plan for extracting cash out of the business while keeping the balance of the cash flow. So my answer is there's no answer, basically. It depends on your plan. If your plan is to literally run the business, extract everything you can, bring the business to break even every year, that's absolutely fine too. But you need to have a balance. You'll probably have a balance of salary, pension contributions, and dividends. Okay. So when your business is established enough that you've built reserves in the business, you can take dividends, which are more tax efficient as a way of extracting funds from the business for yourself. So it depends on your business. Is it a sellable business? That's the first question. And if it is that your long-term plan? And then you want to be leaving profit there and build that up slowly over time, including cash reserves. If your plan is to step to the side or to not sell, if it's not a sellable business, you will probably want to extract as much cash as possible on a year-to-year basis. And I do have clients that will literally in December will have a conversation saying, where's the business at? Right, bring it to break even, put the new costs in, have a new pension, a new salary bonus, and we're going to every year the business looks like it's just broke even, and that's the plan, which is absolutely fine because they know they're not businesses that they'll probably sell on down the line or bring on an investor. So think about the long-term plans, and that's hard to do, especially if you're only in the first few years of business, but potentially start thinking about that. What is the long-term plan? And again, if it is something you're going to sell, you need to have things lined up to sell as well, and that is a long-term plan that could take you 5 to 7 years to get that in place.
Yeah, 100%. I have a client who's a management consultant, and that's what she does. She goes into companies and helps them plan their exit strategy. And sometimes it's succession, actually. It's the founder passing on the business to somebody else, not always family member, but somebody who'll take it over and run it. So it's interesting to hear that. And totally, she would advocate for what you've just said there. It is a 5 to 7 year plan, and it's like now is the time to start. That's really interesting. One of the things that you touched on, Edel, is pension. Excuse me. I've had laryngitis for this week. So I'm just back talking. One of the things you mentioned was pension. And in terms of pension, and I know folks, if you're listening in the US, you're like, what pension? I'm like, the 401k thing, right? The equivalent in Ireland. There's a thing coming in by our government, which is called auto-enrolment. Would you mind just touching on that for a minute or two so people get, like, again, in layman's terms, what's that going to mean for them in terms of costs to their business and overheads? What's that going to look like?
Yeah, it's really important. So it was supposed to be September of this year, and now it's being kicked down the road again to January 2026. And from that point, if you are an employer, including if you're a limited company employing yourself, you'll have to comply with the new pension rules. So Ireland are one of the few developed countries that don't have automatic pension enrolment, where our population are reliant on the social welfare pension. So they need to close that gap. Basically, the government won't be able to support based on the demographics that we got. So very much like, let's say, Australia, a lot of people don't understand the Australia system. As soon as you start working, you're paying into a pension. Okay. So that's basically what it is. So it's for anyone that's, like, say, an employer, but a lot of businesses that have maybe 1 or 2 employees on the books, you still need to offer them a pension. Okay. So there is a state pension called, I think it's My Fund, and that's going to be the default, basically. Okay. So what will happen is your staff member can opt to make contributions to it, but the employer needs to put 1.5% of the employee's wages into a pension contribution, and the state will match that. Okay. So immediately, whatever you're paying your staff, you now have 1.5% of an additional cost on your business. Okay. That's the minimum. A lot of people are using it as a way now of finally putting something in place, because at the moment, the way the default government pension is looking, it doesn't, there's still a lot of questions around it. It doesn't look like it has a lot of flexibility. And particularly if you want to make, if you make a small monthly contribution and at the end of the year you want to put in a lump sum, those kind of things aren't really in place yet. So a lot of people are thinking, okay, this could be a very rigid system to be involved in. Those problems could be teased out by January, but at the moment that's how it looks. So what a lot of employers are doing is putting in their own pension plan. So the requirement is you have a pension plan to offer your staff or yourself. So that's either the government plan or your own. And at the moment, a lot of people are setting up their own plans because it means they can pick who they want to be their pension provider. They can pick the fund they want to go into if they're really risk averse, or the opposite, they can pick what they want, and they can choose the levels they want to invest. Okay. So again, 1.5 is the minimum, but you might say, okay, I'm going to offer staff 2%, 3%. Okay. And use that as a recruitment tactic. But you will have more at the moment, you'll have more flexibility with a private pension fund that you not manage the investments, but you have ownership of the fund rather than using the government fund. Okay. It's more of a control flexibility thing that people are kind of considering at the moment. But so January is the deadline, but there's plenty of time to get organized before then. And I would, if anyone is listening that is in that position, I would definitely start that conversation, even if it's just yourself. You have to have it in place. But if you hire any staff, it's an absolute essential employer compliance issue. You'll have to have it there. So in terms of costs, it's going to be your minimum 1.5% contribution on top of any salary that you're offering.
Definitely worthwhile having a conversation with your bank or your broker, folks, because there's different types of pensions. Again, with my banking hat on, there's like 3 or 4 different types of pension plans that are available, and you just need to have a conversation and see what one can you avail of or is most suitable for you. And again, another great way to take money out of your business is to put it into your pension and save it for future. And with some of them, you don't have to wait until you're 67. That's the retirement age here in Ireland. You don't have to wait till you're 67. It is 67, isn't it, Edel?
Yeah, it's still 67 at the moment, yeah.
So with some of them, you can take them out earlier than that. So you want to just have a conversation with your provider and see what's going to work for you. And that'll come back to what is your long-term plan for your business.
Yeah,
and some of them, you don't even need to be gone out of your business to draw on them early. You can still be working and get your pension too. So have a chat with your provider and figure that out, because it's coming, whether we like it or not here.
Yeah.
And I don't know, for 401k folks out in the US listening, I don't know, you're going to need to talk to somebody who's really clear on that side of stuff. Edel, do you know much about 401ks?
I don't, and I wouldn't even dip my toe into the conversation because I'm sure it's really complicated. But you're right about whether it's 401k or the Irish pensions. It's a great way of extracting profits from the business in a tax efficient way. We get huge tax benefits here for it, so it's a no brainer. But the only thing is, if we're talking about profit first as well, pension is obviously a very long term thing. It's long term thinking, your retirement age. If your business at the moment, if you're only starting to build that slush fund or profit account, whatever we're going to call it, business savings, if you're starting to build that, I would get that to a place where you've got about 3 months worth of operating expenses sitting there, and then get ready with the pension, because you could have that pension sitting there in the long term, have that benefit, but in the short term might be struggling with cash flow. So I would have your short term box ticked first and then go for the pension. With the auto enrollment, again, if you're building your business savings at the moment, I would just put the minimum in and have that there, and then you can top that up with the annual contributions that you can put through. And again, that's something that you can look at every 6 months or year and say, how's the business doing? Now is the time to put a lump sum in and get the tax benefit. But in the short term, you're not constraining the business cash flow wise or overcommitting, basically.
Great advice. Thank you so much for that, Edel. Edel, anything else that you think small business owners, like any common questions that come up from a lot of your clients who I know are just like me, they're online business owners, but anything that comes up repeatedly that we haven't talked about today?
It's usually the overwhelm with, like, they know they need to use their numbers, but it's overwhelm of where to get started. So I would say, look at whatever system people have, look at what information you've already got, and then pick 5 kind of key numbers that you want to see every month and start there. It's a very simplified approach, but it works for a reason. Pick 5 numbers you're comfortable with, and if you had that information every month and took a half an hour once a month to just gather that info, and then use that on a month-to-month basis, and when you're comfortable with that, then build onto that further, basically. Like I say, build the house brick by brick. Use it that way, okay? And then business savings, definitely, again, start chipping away at it, small amounts that need to go in there to just give you breathing space, either between launch periods or for times where you might suddenly lose a retainer client that you weren't expecting. Unforeseen things will always crop up, or The flip side of that is if an opportunity comes up and you need a new team member, a new system, something that you need an investment in, and you don't have the cash flow there, and you have to say no to an opportunity, that's the worst place to be honest. So use your information, but look at what you've already got and start with basics. 5 key numbers, like say break even, profit margin, debtor days, and then pick 2 or 3 that are very specific to what you're working on at the moment or what's your focus. If you're building out a particular income stream, maybe it's profit margin on that stream, but tailor those extra couple of ones of where you're focusing your business on at the moment.
Brilliant. Edel, thank you so much for joining us on the podcast today. It's been packed with insightful information and stuff that I really hope business owners can take and apply practically in their business after listening today. So tell us, where can they find you? What do you have on offer that might be of benefit if anybody's interested in connecting with you and maybe having a conversation to work with you after listening today?
Good stuff. Yeah, so you'll find me on LinkedIn, Edel Hayes, Accelerated Accounting, or Instagram, Accelerated Accounting. They're the 2 best places where I usually am. You'll get me quickest. But yeah, we offer obviously the full year package that we would do all of your compliance work, and then any like VAT returns, bookkeeping, payroll, plus the ongoing support. And then we also do strategic sessions. So if someone just wants to sit down and have a deep dive strategic session, to have a look at their business, a full review, you can book in for those as a once off. If you're happy with your existing accountant, we just need an extra bit of support or an extra set of eyes on things, that's a good way to start too.
Definitely recommend Edel, folks. Honestly, she's helped me turn my business around and actually retain some profits for a change and build up that cash and not have to dip into my tax money for the first time ever since starting my business. So it's been brilliant. Edel, thank you again. I'll talk to you soon.
No problem at all. Lovely chat.
And breathe. How good was that? Oh my gosh. Today, Edel Hayes gives a masterclass on what it really means to know your numbers and own your financial power. From simplifying your KPIs to using tools like Xero to take control of cash flow, and even how to set yourself up for a future exit or just finally pay yourself first. We covered some serious ground. So here's what I want you to do right now. Grab a pen or open a notes app on your phone or laptop and write down the 5 key numbers you need to track in your business. Start simple with some of the ones that Edel mentioned, like your break-even point, profit margin, debtor days, whichever ones really resonated with you. That one small shift will start moving you from stressed out to CEO level strategic. If you want some more of Edel's wisdom or ready to get the support in your own business, head over to the links that she mentioned. Her website is acceleratingaccountingsolutions.com and follow her on Instagram. And if this episode sparked an aha, helped you breathe a little easier, or made finances feel a little less terrifying, share it with your business bestie. You never know who's secretly struggling behind the scenes, and your share might be the lifeline they need. And before you go, don't forget to rate, review, and follow the Master Your Business podcast. It helps us reach more incredible business owners like you and keeps these powerful conversations flowing straight into your earbuds. So, catch you in the next episode, and until then, go master your business.